Ripple is flipping the switch. That's the narrative. One moment, traditional finance operates on old rails. The next moment, the claim is that everything will suddenly run on XRP. Instant global payments. Tokenized assets. Banks integrated. The future turned on. Except that's not how infrastructure works. There is no switch. There's no single moment where legacy systems disappear and blockchain takes over. What's actually happening is hundreds of small integrations stacking on top of each other. Partnerships, pilot programs, compliance frameworks, licensing approvals. Each one is a piece of infrastructure being rewired, not a switch being flipped. And understanding that difference changes everything. Because if you're waiting for one big moment, you'll miss what's actually happening. Slow, operational, institutional adoption that doesn't look dramatic but quietly rebuilds how money moves. If you want to understand what institutional integration actually looks like versus what the marketing says it looks like, subscribe. Because what comes next breaks down the difference between narrative and infrastructure. Let's examine what's really being built here. Let's start with the phrase itself. Flip the switch. It implies simplicity. One action. Immediate transformation. Brad Garlinghouse, Ripple's CEO, used this language but then clarified. It's not one switch. It's thousands of switches. Thousands of small moments where a bank integrates. A payment processor adopts. A regulator approves. A custodian onboards. That clarification is critical because it reframes expectations. If you're expecting a single announcement that changes everything overnight, you're going to be disappointed. That's not how complex systems transition. Legacy financial infrastructure took decades to build. It's not replaced in a quarter. It's not replaced in a year. It's slowly integrated, tested, and adapted over long time frames. So what are these switches? Let's break them down by category because not all partnerships mean the same thing. First category is custody and settlement infrastructure. BNY Mellon was selected as the primary custodian for Ripple's stablecoin reserves. BNY Mellon manages $55 trillion in assets. That's real infrastructure. That's not a pilot. That's a major financial institution choosing to hold reserves for a blockchain-based stablecoin. Why does that matter? Because custody is foundational. Institutions won't use stablecoins unless reserves are held by trusted entities with proper oversight. BNY Mellon provides that trust layer. This signals institutional exploration of blockchain-based stablecoins being structured with traditional finance standards. But notice what this doesn't do. It doesn't make XRP the settlement layer for global finance. It doesn't mean banks are suddenly transacting in XRP. It means one piece of infrastructure, stablecoin custody, has been integrated with a major player. That's operational progress for Ripple's stablecoin infrastructure. It's not systemic transformation. Second category is banking integrations. DXC Hogan is a core banking platform used by institutions managing over 300 million accounts and $5 trillion in deposits. Ripple integrated with this platform, meaning banks using DXC Hogan can now connect to Ripple's payment rails without overhauling their entire system. This reduces friction for testing and pilot programs, but does not guarantee scaled adoption. Banks don't have to rebuild infrastructure to test Ripple's technology. They can plug in. That lowers the barrier to experimentation, but it doesn't force adoption. It makes it easier. There's a difference. Banks that integrate this way can run pilots. They can test cross-border payments on Ripple's network alongside their existing SWIFT transactions. They can compare cost, speed, and reliability. And based on those tests, they decide whether to expand usage or stay with traditional rails. This is how institutional adoption actually works. It's not a mandate. It's optionality. And optionality takes time to convert into scale. Some banks will adopt quickly. Others will test for years. Some will never fully transition because their existing systems work well enough. The integration with DXC Hogan is infrastructure that enables testing. It's a piece of the puzzle, but it's not proof of future adoption at scale. Third category is liquidity and trading infrastructure. Ripple Prime, which acquired Hidden Road, processes around $3 trillion annually. With the Hidden Road acquisition, that capacity expands to $44 billion daily in institutional trading volume. This is about building liquidity rails. Institutional traders need deep, liquid markets to move large positions without slippage. Ripple Prime provides that for digital assets. It allows hedge funds, asset managers, and proprietary trading firms to access crypto markets with the infrastructure they're used to in traditional finance. But here's the key question. Does Ripple Prime's liquidity infrastructure require XRP? Not necessarily. The platform supports multiple digital assets. XRP is one of them. It's not the only one. The value of Ripple Prime is that it makes digital asset trading more accessible to institutions. Whether those institutions use XRP specifically depends on whether XRP solves a problem for them that other assets don't. For cross-border payments, XRP has a use case. It's fast. It's cheap. It's designed as a bridge currency. But for institutions trading Bitcoin, Ethereum, or stablecoins, Ripple Prime is just infrastructure. It's not an XRP adoption driver unless the use case demands XRP. So Ripple Prime is valuable. It's real. But it's not automatically XRP-centric. It's liquidity infrastructure that supports the broader ecosystem. Fourth category is tokenization and institutional investment. Franklin Templeton, managing $1.7 trillion in assets, is a funding partner for XRPL ecosystem programs. Aviva Investors, with $300 billion in assets, is exploring tokenized investment products on XRP Ledger. Tokenization is the process of representing real-world assets as blockchain tokens. Real estate, bonds, equity, commodities. The pitch is that tokenization creates efficiency, faster settlement, fractional ownership, global access. XRP Ledger is positioning itself as a platform for this. Franklin Templeton and Aviva participating signals that major asset managers see potential. But potential is not deployment. These are exploratory partnerships. They're testing infrastructure. They're evaluating whether tokenization on XRPL offers advantages over tokenization on other chains or traditional systems. And here's the reality. Tokenization has been talked about for years. The technology works. But adoption is slow because regulation is unclear, market structure is fragmented, and institutional demand is cautious. Asset managers don't tokenize billions overnight. They run pilots. They test compliance. They wait for regulatory clarity. So Franklin Templeton and Aviva are positive signals. They indicate XRPL is being considered seriously. But they're not proof that tokenization on XRPL will dominate. They're proof that it's in the conversation. Fifth category is stablecoin expansion. Multiple institutions are issuing stablecoins on XRP Ledger. JPYC in Japan. Euro-denominated stablecoins in Europe. Stablecoins tied to local currencies in Brazil and other markets. This is important because stablecoins are the most practical use case for blockchain and payments. They're stable. They're familiar. They represent existing currencies digitally. And if stablecoins are issued on XRPL, that creates native activity on the network. But again, let's be specific about what this means. Issuing a stablecoin on XRPL doesn't require using XRP for transactions. Stablecoins can transact on the ledger using those stablecoins as the medium of exchange. XRP is used for network fees, which are minimal. So stablecoin growth on XRPL increases network activity, but doesn't necessarily create demand for XRP itself. Now, if XRP is used as a bridge currency between stablecoins, that's different. If a payment needs to convert from a yen stablecoin to a euro stablecoin and uses XRP as the intermediary, that creates utility. But that's a design choice, not a default. It depends on whether the liquidity and routing algorithms favor XRP as the bridge or whether direct stablecoin-to-stablecoin swaps are more efficient. So stablecoin expansion on XRPL is real growth. It's adoption, but it's not automatic XRP adoption. It's infrastructure that could support XRP use cases if designed that way. Sixth category is regulatory and licensing progress. Ripple received conditional approval for a U.S. banking charter. This allows Ripple to operate as a regulated financial institution, participating in markets like the repo market and offering services that require banking licenses. This is a big deal structurally. It means Ripple is integrating into the regulated financial system, not operating parallel to it. Regulatory approval gives institutions confidence. It signals that Ripple is playing by the rules, which reduces compliance risk for partners. But notice what this doesn't guarantee. It doesn't guarantee that banks will choose Ripple's technology over alternatives. It doesn't guarantee that XRP becomes a widely adopted settlement asset. It guarantees that Ripple can participate in regulated markets. That's access, not dominance. And licensing takes time. Conditional approval means requirements must be met. Final approval could take months. And even after approval, building out banking operations takes years. This is infrastructure work. It's foundational, but it's slow. Seventh category is the SWIFT comparison. Ripple is working with Consensus, the organization behind SWIFT, to explore interoperability between blockchain and traditional messaging systems. SWIFT isn't going away. It's exploring how to integrate blockchain technology into its existing infrastructure. This is often framed as Ripple replacing SWIFT. That's not what's happening. SWIFT is exploring how blockchain can enhance its systems. Ripple is one of several blockchain companies in those conversations. If SWIFT adopts blockchain technology, it might use Ripple's solutions, or it might use Ethereum, or a consortium chain, or its own technology. The point is, SWIFT collaboration is not SWIFT capitulation. It's SWIFT adaptation, and that adaptation may or may not center around XRP. The collaboration signals that blockchain is being taken seriously by legacy infrastructure, but it doesn't determine which blockchain wins. So after examining all these categories, what do we actually have? We have real infrastructure being built, custody with BNY Mellon, banking integrations with DXC Hogan, liquidity infrastructure with Ripple Prime, asset manager participation through Franklin Templeton and Aviva, stablecoin issuance across multiple currencies, regulatory approval progress, conversations with SWIFT. Each of these is a piece. Each one matters, but none of them is the switch. None of them transforms the entire system overnight. What's happening is gradual integration. Ripple is building infrastructure that allows traditional finance to interact with blockchain-based systems. Some institutions will adopt quickly, others will test slowly. Some will never fully transition. This is how complex systems change, not through revolution, through evolution, piece by piece, integration by integration. And that process takes years, sometimes decades. The internet didn't replace traditional media overnight. It took 20 years. Email didn't replace physical mail instantly. Cloud computing didn't replace on-premise servers in a quarter. Blockchain integration into finance will follow the same pattern. Slow, operational, incremental. And the institutions leading that integration, like Ripple, are building the rails that make it possible. But rails don't force adoption. They enable it. Adoption depends on whether institutions find the new rails better than the old ones. Cost, speed, reliability, compliance. All of those factors determine whether the infrastructure gets used at scale. So when you hear about partnerships and integrations, ask what's actually being built. Is it a pilot? Is it full deployment? Is it exploratory? Is it operational? Those distinctions matter because they separate narrative from reality. If this changed how you think about infrastructure versus transformation, subscribe. We're here to explain what's actually being built, not what marketing says is being built. Drop a comment if you've noticed the difference between incremental progress and the narratives around it. Let's talk about how to evaluate infrastructure development critically. Because the goal isn't to dismiss progress, it's to understand it accurately. Ripple is building real infrastructure, but infrastructure takes time. And understanding that timeline protects you from false expectations. This isn't a switch. It's a system being rewired piece by piece. And that process doesn't happen in headlines. It happens in boardrooms, pilot programs, and compliance reviews. Slowly, deliberately, and only time reveals whether it succeeds.